What if everything you believed about money was only half the story? What if building wealth had less to do with intelligence and far more to do with behavior? Why do some people with average salaries retire as millionaires, while others who earn huge incomes remain trapped in debt? Why do smart investors sometimes lose everything, while ordinary people quietly build fortunes over time? The truth is uncomfortable. Money is not just about numbers. It is about how we think. It is about our emotions. It is about fear, patience, ego, and habits. And that is exactly what this story is about. This is the story behind money. Not the formulas, not the spreadsheets, but the psychology. Because when it comes to money, doing well is not about being smarter than everyone else. It is about behaving better than most people. And once you understand this, your entire relationship with money may change forever. Part 1. Nobody is crazy. Let us begin with one powerful idea. No one is crazy when it comes to money. People from different backgrounds make financial decisions that may seem irrational to others, but their choices make sense to them. Imagine someone who grew up during a time of extreme inflation. Their parents saw savings become worthless overnight. To them, investing in the stock market may feel dangerous. Now imagine someone who grew up during a booming economy. They watch markets rise year after year. To them, investing may feel obvious and safe. Both people look at the same financial world, but they see two completely different realities. Why? Because our financial decisions are shaped by our personal experiences. Most of what we believe about money is not learned from textbooks. It is learned from childhood, culture, family habits, economic conditions, personal successes and failures. Someone who experienced the Great Depression thinks differently about money than someone raised during a tech boom. And this is why financial advice often fails. Because advice assumes everyone sees money the same way. But they do not. People do not make financial decisions based on spreadsheets. They make them based on their life story. Understanding this simple truth can make us more patient, more empathetic, and wiser with our own decisions. Part 2. Luck and risk. Another uncomfortable truth about money is this. Luck and risk play a bigger role than we like to admit. When we see someone extremely successful, we assume they must be incredibly smart. When we see someone fail, we assume they made terrible decisions. But reality is rarely that simple. Consider the story of two individuals. Both work hard. Both are intelligent. Both take risks. One becomes a billionaire. The other fails completely. What made the difference? Sometimes, it is simply timing, or luck, or being in the right place at the right moment. This does not mean skill does not matter. Skill matters a lot. But luck and risk always exist, and ignoring them can be dangerous. When we look at the most successful investors or entrepreneurs, we often only see the winners. We do not see the thousands of others who tried the same thing and failed. This is called survivorship bias. It makes success look easier than it really is. Understanding the role of luck helps us stay humble. Understanding the role of risk helps us stay cautious. Both are essential for long-term financial success. Part 3. Never enough. One of the most dangerous financial traps in the world is the idea of never having enough. History is filled with people who had enormous wealth, but lost everything because they wanted just a little more. One of the most famous examples involved a hedge fund manager who was already incredibly rich. He had more money than he could ever spend, but he continued taking bigger and bigger risks. Eventually, those risks destroyed everything. Why? Because greed is powerful, and comparison is even more powerful. It is easy to feel rich until you meet someone richer. Then suddenly, what you have no longer feels like enough. But the truth is simple. The hardest financial skill is not making money. It is stopping when you have enough. Knowing when to say, "This is sufficient. I will not risk everything for more." This mindset protects wealth far better than chasing endless gains. Part 4. Compounding, the most powerful force. Albert Einstein once supposedly called compound interest the eighth wonder of the world. Whether he actually said it or not, the idea remains powerful. Compounding is simple. Money that earns returns. Then those returns also earn returns. Over time, the growth becomes enormous. But compounding requires something that most people struggle with: patience. Let us imagine two investors. The first earns incredible returns for a short period of time. The second earns moderate returns, but continues investing for decades. In many cases, the second investor ends up far wealthier. Because time multiplies money in ways that are difficult to imagine. One of the greatest investors in history, Warren Buffett, did not become extraordinarily wealthy only because he was brilliant. He became wealthy because he invested for more than 70 years. Time was his greatest advantage. The lesson is simple but powerful. Getting wealthy is less about extraordinary talent and more about consistency over a very long time. Part 5. Getting wealthy versus staying wealthy. Making money and keeping money require completely different skills. To get wealthy often requires risk, optimism, bold decisions. But staying wealthy requires humility, caution, discipline. Many people succeed in the first phase, but fail in the second. Because once someone becomes successful, it is easy to believe that success will continue forever. But markets change, economies change, life changes. The people who keep their wealth for decades are usually not the most aggressive investors. They are the most careful. They understand that survival is the key to long-term success. Because if you avoid catastrophic mistakes, time can work in your favor. Part 6. Tails you win. In the world of money, not every decision needs to be right. In fact, some of the most successful investors in history were wrong most of the time. But when they were right, they were very right. This is called the power of the tail events. A small number of extraordinary successes can make up for a large number of failures. Think about venture capital investors. They may invest in 20 companies. 15 fail completely, or perform moderately, but one becomes a massive success. And that one success pays for all the failures. The same pattern appears in the stock market. Many companies struggle or disappear, but a small number of companies create enormous wealth. This is why diversification matters. Because you never know which investment will become the extraordinary winner. Successful investing is not about always being right. It is about positioning yourself so that when rare opportunities appear, you are ready to benefit. Part 7. Freedom is the greatest dividend. Many people believe the ultimate goal of money is luxury. Big houses, expensive cars, designer clothes. But the real value of money is something far more powerful. Control over your time. The ability to wake up in the morning and decide what you want to do with your day. To spend time with people you love. To work on projects that matter to you. To say no to things that drain your energy. This is the highest form of wealth. Freedom. And yet many people chase money in ways that destroy the very freedom they desire. They work endlessly to maintain lifestyles that impress others. But true wealth is quiet. True wealth often looks simple. Because the goal is not to display wealth. The goal is to buy independence. Part 8. Man in the car paradox. Imagine you see someone driving an expensive sports car. What is your first thought? Most people think, wow, that person must be very successful. But here's the paradox. When we see someone with luxury items, we rarely admire the item itself. Instead, we imagine how people would admire us if we owned it. In other words, luxury spending is often driven by the desire for respect and admiration. But the truth is ironic. When someone sees a luxury car, they are not thinking about the driver. They are thinking about themselves. They are imagining how good they would feel driving that car. This means the admiration we seek through material possessions rarely works the way we expect. Real respect comes from something deeper. Kindness, humility, wisdom, financial stability. These things are invisible, but far more meaningful. Part 9. Wealth is what you don't see. There is a major difference between being rich and being wealthy. Rich means having a high income. Wealthy means having assets that generate security and freedom. Rich people often display their money, but wealthy people often appear ordinary. Why? Because wealth is invisible. It is the money that has not been spent. It is the investments quietly growing in the background. It is the savings that create stability during difficult times. Imagine two people who earn the same salary. One spends everything to maintain an impressive lifestyle. The other saves and invests consistently. Years later, the second person possesses something far more valuable than status. They possess options. And options are one of the greatest forms of power in life. Part 10. Save money. Saving money is often misunderstood. Many people believe saving requires a high income. But the truth is simpler. Saving depends far more on behavior than income. A person who earns a modest salary but controls their lifestyle can save consistently. A person with a very high income but endless spending habits may save nothing. Savings provide something incredibly important: a margin of safety. Life is unpredictable. Jobs disappear. Economies crash. Unexpected events happen. Savings create a buffer against uncertainty. And the larger that buffer becomes, the more confident and calm you can feel about the future. Part 11. Reasonable is better than rational. Traditional finance teaches us to make perfectly rational decisions. But humans are not perfectly rational. We are emotional. We are impatient. We are influenced by fear and excitement. Because of this, the best financial strategy is not always the most mathematically optimal. It is the strategy you can stick with for decades. For example, a highly aggressive investment strategy might produce slightly higher returns. But if it causes stress and panic, you may abandon it during a market crash. A slightly more conservative strategy may produce lower returns. But if it allows you to stay calm and consistent, it may lead to better long-term outcomes. The goal is not perfect optimization. The goal is sustainable behavior. Part 12. Room for error. One of the most important concepts in finance is simple. Always leave room for error. No one can predict the future perfectly. Markets can crash. Unexpected crises can occur. Businesses can fail. If your financial plan only works when everything goes perfectly, it is a dangerous plan. Successful investors build strategies that can survive mistakes, uncertainty, and bad luck. They keep cash reserves. They diversify investments. They avoid excessive debt. This margin of safety ensures that when surprises happen, they can continue moving forward. Part 13. The long view. When people look at the stock market day by day, it can appear chaotic and frightening. Prices rise. Prices fall. News headlines predict disaster. But when we step back and look at decades instead of days, a different pattern appears. Despite wars, recessions, and global crises, economies grow. Businesses innovate. Productivity increases. Human progress continues. The long-term trend of economic growth has been one of the most powerful forces in history. But benefiting from it requires patience, because short-term volatility often hides long-term progress. Final reflection: the true psychology of money. At its core, the psychology of money is not about maximizing returns. It is about building a life that feels secure, meaningful, and free. The most successful people with money are not necessarily the smartest investors. They are the ones who control their behavior, remain patient, avoid catastrophic mistakes, focus on long-term progress, and understand the emotional side of money. Money is not just numbers on a screen. It is a tool that can buy freedom, a tool that can reduce stress, a tool that can allow you to live life on your own terms, but only if it is used wisely. Because in the end, financial success is not determined by how much you know. It is determined by how you behave. And behavior is something anyone can improve.